Welcome to the Break Free Real Estate Podcast, your daily guide to financial freedom through real estate. I'm your host, Jocelyn Kaufman, and today I'm here with Stewart Heath, and I'm super excited to have him on the show. I think it's going to be a great interview. And Stewart, how are you doing today?
I'm doing great. And I'm so honored that you've had me as a guest on your podcast. Thank you very much.
Yeah, so I'm from Utah and Stewart's from Tennessee, so you guys can go ahead and decide who has the accent, but we both think each other do. Stuart, do you want to outline for us what your current real estate portfolio looks like? What you're doing right now with real estate?
Yeah, I got out of residential real estate several years ago, more as just a personal preference. I do believe those are probably the bread and butter type investments. But right now at Harvard Grace Capital, we have two holdings. One is a large self-storage facility in Huntsville, Alabama, and the other one is an office building in a Nashville suburb called Spring Hill, Tennessee. And I know there's a lot of media attention about office, as there was when we bought the property. But people need to realize that there are at least six subcategories of the office asset class. And we focus primarily when we do office, we look at suburban office, which is where State Farm agents are, and dentists and mortgage companies, and I like to call it consumer focused office space. So it's service retail, I think, is the official name of the sector, or suburban office. And I mean, that our office building is full. I wish I had three more just like it, because I could fill them up. I mean, I literally turn people away every week. And I think you're going to find that to be across the country, that suburban office service retail is going to stay strong. I think where you look at where the problems are downtown central business district, 10-story office buildings. That's where the people don't want to go anymore, and they want to work from home. But your doctor is not going to remote in. He has to have an office space, and the same with your dentist. And so whether it be a restaurant or some other sort of service business, they got to have space. They got to have space. So I went off on a tangent about office space, but our holdings are self-storage and office, and we have two contracts open on one's a retail complex in Fayetteville, Tennessee, where I live, which is 15 minutes north of Huntsville, and then another suburban office, medical office in Huntsville, in the hospital district.
Awesome. I am hearing everything you're saying. I think residential office space is nice because most businesses are going to pay you rent. Like, you don't really have to worry about them destroying or having parties or whatever you might have to with regular tenants. And I also agree with the fact that maybe the downtown office spaces are the ones that are struggling. Do you find that you're getting better deals on the type of office space you like? Because everyone's seems like there's a lot of bad blood about office spaces. So do you feel like you're getting better deals now because people are exiting, or?
I don't think they're exiting yet. So right now, and I could perhaps probably get better deals if we were structured differently, but Harvard Grace is meant to be is meant to deliver to investors cash flowing investments, stabilized cash flowing investments. So we're not doing development, and we're not doing speculative deals, although I see them all the time, and some of them I just really want to do.
Yeah.
And we may someday, but our sort of main tenet is that real estate, and thereby cash flow, should be the core and the foundation of everybody's investment portfolio. You can get cash flow from stocks and bonds and stuff, but you get
Mm-hmm.
the wild variations in the principal. Like
Yeah.
I hold some shares of Verizon right now, and it's wonderful. It has a 7.5% dividend yield, but the stock's down $20 in a
Yeah.
year. You know,
Yeah.
so you know, and you just don't typically see that. So our philosophy is that build your foundation with cash flowing assets, and cash flowing assets don't generally fluctuate in value either, because they will cash flow in higher interest rate times or low interest rate times. So we put fixed debt, stabilized properties, and then you sort of set it and forget it for a while.
Mm-hmm.
I moved away from residential mainly for my personal preferences, but you sort of referenced it. Um, but I sort of got there from a financial standpoint. When I do a lease, I'm doing a lease for 3 to 5 years.
Yeah. Yep.
I don't have to rent that property again for 3 to 5 years. And in residential, and it's all baked in, but it's much more management intensive, because
Mm-hmm.
you got people coming and going, and every year you might have to at least go in and clean the carpets and touch up the paint.
Yeah.
Um, it's just a lot more management intensive, and we manage our own deals.
Mm-hmm.
And so these sort of fit our lifestyle. Now, I am not against multifamily. It's an awesome asset class. It
Yeah.
is, and it is the core, really of the real estate economy right now. And
Mm-hmm.
I don't think anybody's going to go wrong with a multifamily deal.
Yeah. Yeah. I mean, I personally am of the belief that diversifying, your portfolio. I have, I mean, personally, I have some small residential office space. I love it because it's like 5-year lease. You don't have to worry about them making payments. I mean, it's really, really easy to manage. And then I have multifamily and then some single family and some short-term rental. And it's like every time of one thing is struggling, everything else is doing great most of the time. And so I I'm always preaching like diversify, diversify, diversify. But I see the value in just going all in on, one type of asset class because you're going to become really knowledgeable about it and you're going to be able to analyze deals better and probably get better deals in the long run. Um, so you say that you started with single family residence. Um, and so when about was that when you were doing single family rentals?
Well, I'm an old guy, so I bought my first investment property in 2001. So as we were talking in the pre-show, so I'm a CPA. I'm certified public accountant. I've been practicing since 1985 when I got out of college, and started my own firm in '89, and just watched my clients flipping houses and doing all this, way before it became cool and people were doing TV shows about it. And I'm just like, wow, they just cashed out 200K on a flip. And it was a $600,000 flip, and a whole lot of work. And
Yeah.
I've only ever done one flip, and I figured I made $1 an hour on it. So,
Mhm.
and it's a hard thing to do, but I noticed that it was real estate that fueled them, and all of those guys who were doing flips had a base of duplexes or
Yeah.
small houses or a small apartment building, just sort of as a base of cash flow, and then they did the flips for bonus money kind of stuff,
Mhm.
and I had several of them, and sitting down one night, you know trying to figure out why I was so frustrated with life, in the middle of tax season. And it's like, well, you're not doing any real estate for one. So anyway,
Yeah.
I started into it, and bought a duplex in the hood in 2001. 9 months later, I bought 14 duplexes in a group in North Nashville. And from there, I started building houses. with one of my clients, and then got into other types of development, and I just but then by 2009 I was sort of upside down, because as other people were.
Yeah.
I didn't make it through that very well because I had become very heavily leveraged. So, but it wasn't the real estate's fault. That was all my fault. So,
Yeah. So, I know a lot of people right now are kind of worried that something like that's going to happen again. What would you say if you could go back to like 2007, that you would have done differently to avoid getting hurt by 2008?
um, well, for one, I wouldn't have added so many projects in at one time. I was renovating 72 condos. I was constructing office condos, and then had a few single family homes I was building at the same time as trying to manage 200 rental units that I had acquired over those years. Yeah, it was nightmarish, and I'd done it all with hardly any money or actual, it was equity. I'd buy this asset, wait a year and a half, leverage that, take cash out, buy something else, and I had a lot of willing bankers along with me along the way. And I was kind of convinced that the world will never turn around.
Mm-hmm.
Well, it did in 2008, and then lasted through 2009. Um, so the lesson number one, I would say, uh, be careful of your debt. Debt is a wonderful tool in real estate, and it actually drives real estate valuations.
Mm-hmm.
Uh, I was doing pretty much everything with 90% or better leverage, which in hindsight is kind of stupid. These days, I had a lunch just yesterday. I have a deal, and it's sort of a reposition deal, but it will cash flow. So I've got a medical office in Huntsville that the doctor's leaving, but we're going to go in, and it's still cash flowing with the other tenants. The doctor owner is leaving. Anyway, so it's a reposition, and it's not very much money. And I had a lunch yesterday with the banker, and I said, I want to do a 60% loan to value. And 3 or 4 times he came back, yeah, but we can go to 80. We can go to 80. And I'm not opposed to 80% financing on a fixed basis on a stabilized property. We've done some of that. I just said, look, I'm not ready for that. We're bringing almost half the cash
Yeah.
because we're going to have a reserve. But while I expect this thing to stabilize within really 12 months, but we're banking that it's 24 months. And then we'll refinance at 80%, and hopefully likely lower interest rates too. So, my attitude back in the day was, well, if the bank thinks it's okay, then I should do it. No, you can't pass that buck. You have to use your own brains. And every deal we've done, we've got reserves sitting in the bank. It lowers IRRs a tad because I've got $250,000 sitting over here that I don't think I'll ever need.
Mm-hmm.
And even more like on our storage units, which are 100% full, and and have a waiting list. But I may never need that money, and so if that's the case financially, it will lower the IRRs, but I don't care because
Yeah.
nobody knows what's coming. Nobody knows what's coming.
For sure. Yeah, no one has a crystal ball. Do you, when you're putting that money aside, do you put it aside from the beginning, or do you have like a percentage you take out of the gross rent?
You know, we establish a reserve at closing. We do have one property that we're starting to add reserves onto that because we've decided that we want to repave the parking lot in 3 years. So we're starting to set aside money, and we hold that back from net operating income, set that aside. and over appropriate time. So, none of this is rocket science. Some of it's just good common sense stuff, but it's easy to think the good times will never end. So,
Yeah. Yeah. Well, I think, the last couple years, everyone was hopping into real estate and like, this is amazing. Anything you can buy, just buy everything that you can buy. And I mean, I don't think it was, I think there were still good deals that people could buy, but I think the problem was people were buying a lot of bad deals. And now, like, I'm a realtor in Utah and I see deals on the market that I know that I see were bought in that period and they're not going to sell them for what they need to.
no,
Um, yeah, I mean, I'm always preaching like know your standards, know what return you're looking for, what cap rate you're looking for, and no matter what time it is, like no matter how hot the market is, make sure that you're sticking to your standards because deals will come.
yeah,
Um, yeah, that's great. I think, you know,
yeah,
I personally was a kid in 2000. I was like 16 in 2008, and my mom actually lost her house in 2008. And I remember being very upset with her. Like, I didn't tell her I was upset with her, but like inside, I was like, I'm never going to let that happen, because we bought a house we didn't need. It was too big. It was essentially her dream home, but we didn't need it. Our other house was fine. And, and it kind of hurt her financially because she had to claim bankruptcy. But I remember seeing that when I was younger and like that's where the flip switched in my brain. Like never buy something you can't afford.
right.
Um, I still drive like a crappy car because I don't want to spend a lot of money on a car. I'd rather, invest that money in something else and always buy something that is going to make money, at least a little bit, or at least break even, and always put aside reserves because, like you said, you never know what's going to happen.
It's not my nature, but it's something I learned the hard way. And so, something you touched on a minute ago. One of the reasons we've sort of stayed away from multifamily, especially the last few years, not because we think it's bad, it's just that the valuations were too high. I know of deals here in Nashville that sold for a 3.5 cap rate. I just, you know, I did a deal last year where our financing was 3.25%. So, but that was pretty rare and it lasted about a month and we locked it in for 10 years and away we go. We're proud of that one, but people were borrowing at 5% and buying at a 3.5 cap. It was like, guys, you're upside down. I mean, and you see the deals, and they were underwriting the deal that rents go up 12 to 15% a year, and they might. We've
Hmm.
certainly seen that they have gone up that high, but
Yeah.
you can't count on it. And now rents, they're not increasing anymore. They have stabilized. They're not falling yet. But so we're going to see a lot more deals
Yeah.
uh, hit the streets here soon.
Yeah. I'm ready. Just kidding.
Yeah.
Um, yeah, and I mean, I don't understand how a majority of the renters, I don't think rents can raise. Like, I really don't see how that's possible because I think it's a crazy statistic. Like 80% of people can't afford a $400 emergency. So if you're raising someone's rent 300 bucks a month, like that's impossible. There's no way people can afford it.
Right.
Um, And then you're gonna have bad tenants or I mean, the government's gonna have to step in at some point, in my opinion, but
Yeah.
it's
Well, they
gonna
did
be
in
very
2020.
interesting. What?
They did in 2020.
Yeah. When I analyze properties, I haven't shared this on this podcast, but when I analyze properties, I actually use the fair market rents, the HUD fair market rents for my numbers
Oh, wow.
because yeah, and they actually have them public for every single county and every single state.
Yeah.
And so I just have them on like a separate spreadsheet that automatically takes the rents, and I just feel a lot better about it. And also in Utah, anyways, most of the rents on the market are lower than the HUD rents, which is interesting to me.
Yeah,
But it's like worst case scenario, if the government steps in, they're not going to go above this number. They're not going to go above what they have posted for the year. And so I use that number to analyze my deals. And that's what I go off of.
that's smart. Yeah.
Yeah, I just started doing it like a month ago, but I tried Rental Meter, but I found that they aren't as like they're accurate, but they're very high. Like they're a lot higher than the HUD rents. And then Zillow is always lower. And so I was like, you know what? I'm just gonna go off this because it's very standard. It's per county, and it's just a simple
Yeah.
calculation. So
Yeah.
awesome. Well, we are nearing the end. This has been such a valuable conversation, honestly. I personally have learned so much. So, um, I really appreciate that because I think, your experience, especially being through one of the biggest housing downturn in my generation, at least, is um, something that I think is still fresh in people's minds, but they're kind of forgetting about it. Like, we don't think it's possible. I personally don't think something like that extreme is going to happen, but I do see that it can happen. Like, there's still like a chance that something extreme can happen. Um, but anyways, final questions. What has been your biggest mistake in real estate?
Well, I think I touched on it. Too much debt, too fast, too much leverage. But I really say it this way: the lack of planning for contingencies. So the lack of building reserves. Um, and I can put it in context like this. So in 2008, I prepared a financial statement for a deal for a bank in Tennessee, and based upon appraised values, so no funny business, my real net worth was in excess of $10 million. There was almost $26 million worth of appraised value, debts, and then net worth. And I was feeling pretty good about my bet. That was June 30th, 2008. That was election year. So 60 days later, Countrywide Mortgage, the largest mortgage lender in the world, told everybody on July the 27th that they couldn't fund their loan scheduled to close on July the 31st. 4 days later. Oh, wow. Well, that sounds bad. And then a little bit later, the financial crisis was officially announced, and John McCain and Barack Obama were running against each other. And McCain says, we need to go back to the Senate and help fix this problem. And by the end of September, so 90 days after I did that, by my calculation, I was underwater $5 million. Just because when the banks pull out, your real estate's not worth near as much as it used to be. And obviously, it didn't last long. But had it been for reserves of $300,000, I'd still own some of those assets today. If I had just had enough carrying power, for 12 months, but I didn't. I was plowing everything back in, and so that's what reserves mean. You've got to keep money on the side. Call it an emergency fund, call it whatever you want.
Yeah.
That's
How much, sorry, how much would you suggest before you buy a property? How many months of payments would you suggest to have in reserves?
We typically reserve 9 months. 12 just seems too many, and 6 doesn't seem to be quite enough. So we've just chosen 9 months, with the exception of the one I was just referring to, where we've intentionally stockpiled 2 years worth, which once the property stabilized, we'll give back to the investors. So after we keep a reasonable reserve. So.
Cool. Awesome. And do you change that at all at the property, like cash flows more than the others, or do you kind of just keep it fairly standard?
But we keep it fairly standard. So,
Cool.
like in a few years in some property, when we refinance, we'll do a cash out refinance and send money back to the investors. We'll hold on to that, will actually, because the payment will be bigger, that will increase our need for reserves. So we'll increase the reserve and then send the rest back out to the investors.
Awesome. Okay, next question. What is one thing you wish you knew beforehand?
Oh, well, when financial crises are gonna be. So, I wish I knew the future.
Yeah,
Um,
that'd be cool.
I wish that I had uh, known that I should have been a little bit more disciplined. Real estate is fun. I find it
It's addicting. Yeah.
it is addicting. It's like you're working the same formula multiple times. To me, it's just financial paper when you're talking about cash flowing real estate. But I wish I had known. I'm a passionate guy, so I wish I had been smart enough to keep my emotions in check.
Mm-hmm. Yeah. I think analytical people do really well in real estate because it's literally about the numbers. Like, obviously, there's other factors, but the numbers is the most important factor, in my opinion. And I mean, sometimes when I'm working with some clients, they get emotionally attached. I'm like, stop,
Right.
stop it. This is not going to help you. It's only going to hurt you.
Yeah. And I feel like I've gotten fairly good at it. One of the properties we just put under contract, I've been doing a dance with the seller since before Thanksgiving. And I just look, it's worth what it's worth. Yeah, and we're getting this
Hmm.
one $1 million below asking price. Which is almost less than 2/3 of his asking price. I mean, but bottom line is that's what my numbers show that
Hmm.
I can pay for, and yeah, and so never got emotional. Didn't argue with him. He just finally came to the realization that I can either take a couple of years and fix the property himself by putting good tenants in and doing stuff, or he can sell it now. So
Yeah. Awesome. Yeah, I've heard that a lot that it's like I've been offering this for this long and finally they realize that that's what they're going to get. Unless maybe they hold on to it for another 5 years.
yeah,
Then they could probably get more.
yeah.
Um Next question, what is your favorite real estate book?
My favorite real estate book is, if I can find it right here. I'm in a group with this guy, Rob Beardsley. It's all about structuring and raising debt and equity deals.
What's the title of it?
Structuring and raising debt and equity for real estate. So
Nice.
it's very short to the point. Rob is a brilliant young man. He's done over 300 million in multifamily transactions in the last, oh, I don't know. It can't be that old. I'll say 6 to 8 years, and down in Texas, Lone Star Capital. Brilliant guy, and great book. Another one is Raising Capital for Real Estate by Hunter Thompson.
Cool.
So there you got a freebie. You got an extra favorite book. So
Awesome. Thank you. And then final question, how can people find and connect with you?
best way to get with me is harvardgracecapital.com. Got a brand new website up. You can join the mailing list or find the link to book some time with me. I love talking real estate. So my Calendly link is there, and you can grab some time, and we can talk about anything you want. But you can also find out about our deals that are going on there, and our existing deals. So there's some free resources available there as well.
Awesome. I will plug all that in the show notes. Thanks so much for coming on the show, Stuart. This was great conversation and I really appreciate it.
Thank you so much. Appreciate it.
That's it for today. For more daily investing tips and real estate secrets, don't forget to visit breakfreerealestate.com and make sure to like, subscribe, and share our podcast. We will see you tomorrow.